All right, hello, folks. Welcome to the July session of Macroeconomics Hours. So today we'll be talking a little more about tariff, and my colleague, Professor Esfahani, will start this conversation by going through the theoretical framework of tariffs. Hadi, it's all
Okay.
yours.
Just a second. Let me share my screen and
But also, meanwhile, folks, don't hesitate to ask questions live. Just unmute yourself and ask questions if you'd like to ask something, or put the questions in the chat. Hadi and I will keep an eye on that during each other's portions of the presentation.
all right, welcome to today's macroeconomics hour. And the topic that we have chosen for this week is tariffs, Trump's tariff tantrum. I made that up, TTT. To We want to know what are tariffs doing to the US economy and other economies, and we want to know what to expect in terms of the adjustments that are going to be made in the policy. We have a selection of readings, all from The Economist, How to Strike a Trade Deal with Trump. America cannot dodge the consequences of rising tariffs forever. Tariff hopping, this means countries that are facing high tariffs in the US, what they might do is to move their products to a third country and export from there. And then US government has to trace all these products to figure out whether this is originally from the country from which it's exported, or is it made in China and then re-exported from the third country. And finally, how America's economy is dodging disaster. Now, I'm going to start actually by analyzing trade policy from a microeconomics perspective. We want to know, what does a tariff do to the price and quantity of an imported product? And we want to know also what other factors shape the amount of this change in price or quantity. And finally, we want to know who gains, who loses, welfare of consumers, the effect on producers, and the economy as a whole. So, very briefly, just to remind you of microeconomic microeconomics of a product that is imported. Suppose this is the domestic demand curve. Those of you who haven't taken microeconomics, just as the price goes down, people buy more. So that's what this curve represents. And this is the supply curve. Usually, when price goes up, producers are eager to produce more. That's the normal situation. We could have other situations where this supply curve, domestic supply curve, could be flat or could be more horizontal, could have different angles, but it crosses the demand curve at some point like A. And if the country is not trading with the rest of the world, then this point A will be the domestic equilibrium under autonomy. But if the world price is below this PA, then here I'm assuming that the supply curve of the world to this country is elastic, meaning that at the world price, if any seller wants to sell higher than that, there's going to be tons of suppliers trying to compete and therefore push back the price down to PW. If a supplier tries to sell at a lower price, then all of the demand is going to go towards that supplier. And if the cost of production is a given across countries, that country selling below the cost is going to be losing a lot of money and it's going to be driven out of the market. So here we have PW, which is the average or the typical cost in around the world. And here I'm assuming that the world is willing to supply this product at this given price. And if this country is trading with the world, then price PW is going to dominate. So let's see. If the price is PW, then point C tells us how much people are willing to buy this product. So QD becomes the demand. And point B represents how much our domestic suppliers are willing to supply the product. So that we call this Q as quantity corresponding to supply. And the difference between these two is going to be a shortage domestically, which is going to be filled by imports. Now, suppose that we impose a tariff on such a market. So this is what we had before, and the government says if you want to import from the rest of the world, you should be paying for each unit amount T. So T is a sort of tax on imports. That's what we mean by tariff. If this is the case, then domestic buyers, consumers, are going to be facing a price which is PW plus T. They have to pay the foreigners and pay the government in order to be able to buy the product. With the higher price, quantity demanded goes down, quantity supplied goes up, and imports shrink. So it's interesting that right now in the US, imports last quarter or 2 quarters before in spring, imports actually went up when the tariffs were announced, possibly because importers wanted to import more in order to have sort of to stockpile imports that they thought might become more expensive in the future. So in this situation, this is the green area here is the amount that domestic consumers are going to be paying for the imports. This has two parts. One part is up here is tariff revenue, the tariff times the amount of imports. And the lower part, which is between PW and zero here, this green area, is the part of the payment from our consumers to which goes to the rest of the world. So our consumers pay the tariff and pay for the imports. The rest of the world, in this case, if the world supply curve is flat, all countries can produce essentially at the same price, and there are suppliers that can meet the market demand at that price, then that price is going to be dominating world market. Our consumers have to pay all the tariff. So I'm going to discuss the case of where the world supply curve is not flat like this. So in a moment, this example, I call it large country because uh, most countries that have small markets relative to the world face given prices from the rest of the world. And if they increase their expenditure, their imports, or reduce them, has no effect on in global market. But if a country is large like the United States, if the US decides not to buy a product or reduces imports from the rest of the world, the market in the rest of the world is going to be affected by its action. So see how can we bring that idea into this graph? Again, PA is the price under autonomy. PW is world price right now, but this is a large country. So when a tariff is imposed, price goes up for domestic consumers. But domestic consumers are going to reduce the amount that they want to buy because it's more expensive for them. But when they reduce their demand for this imported good, the price of the imported good in the world market is going to go down. So it's going to go to somewhere like P prime W. And the tariff is going to be P prime W plus T. So it's not, the price domestically does not go up as much as the tariff. And depending on how the rest of the world responds, how much the price goes down, the domestic price is going to be lower. And in fact, if the rest of the world is has a vertical supply curve, then when the tariff is imposed, then the price is going to be driven down driven down so that PW remains in effect. The difference between P prime W and PW is going to be the amount of tariff that foreigners have to pay now, mm, rather than domestic consumers. So if this is the case, this is the general case when a country has some market power and can drive down the price. And this is what Trump has in mind, that if he imposes tariffs on imports, then what's going to happen is that a little bit of it is going to be imposed on consumers, and some of it is going to help domestic producers produce more. Imports will shrink. Imports will shrink, and but the benefit this has for the US, for the large country, is that the amount of that you pay to foreigners is going to be this green area, which is lower than what we had before. Up there, we have tariff revenue here in this red shaded area. And this tariff revenue, part of it comes from domestic consumers, part of it comes from foreign producers. So the top rectangle is the amount of the tariff that is paid by domestic consumers, and the lower rectangle here is the amount that is paid by foreigners. Trump believes that this top rectangle, this one, is much smaller than the amount down here. And in fact, that seems to be, for now, the case. So let me go a little bit further and show you what's the impact on consumers, producers, and the economy as a whole. Those of you who have taken microeconomics probably remember that the area between the demand curve and the price line, this triangle, is the consumer surplus. Essentially, the idea is that consumers are paying PW, and this is before any tariff. Consumers are paying PW, but they're willing to pay the amount that the demand curve shows. So the difference is some surplus left for the consumers. Now, if you impose tariffs, uh, a tariff on this product, and I'm going to look at the general case where the country could push down the world price a bit or a lot. And what we see here is that quantity demanded goes from QD to Q prime D, and consumer surplus after tariff is going to shrink. And the blue trapezoid right here shows how much consumer surplus is going to be lost. So this is consumers' loss, and we can do the same thing with producers. This is the producers before tariffs, initial producer surplus. Producer surplus, again, is the difference between price and cost of production, which is represented by the supply curve. So that's what the profit that producers are collecting from point zero to QS. That's the amount being supplied. Once tariff is imposed, then world price might be pushed down and the domestic price becomes P prime plus that T. And this new price line for the consumers crosses the domestic supply curve at E. So we're going to have a new supply amount of Q prime S. Now, producers gain this red area. Their surplus was blue area, but then once the tariff kicks in, then they can sell their product at a somewhat higher price, and as a result, they make some additional profit, which is represented by the red area. That's producers gain. If we put all these things together, so this was the consumer surplus, which was shrinking as a result of the domestic price rising by T, part of T, and part of T is imposed on foreigners. We saw that the area, the trapezoid, is the consumer's gain. Here's the domestic supply curve added to this graph. And here we have quantity supplied increases as a result of the price rise domestically. And that's producer surplus. So you can see that essentially the two areas that are shaded are consumer loss. Part of that is captured by producers, and this area that we discussed before, this is here, the color is a bit different, but this is essentially the tariff revenue, the two rectangles. But this lower rectangle, the red one, is this is the amount that foreign producers have to accept to lose in order to be able to sell in this economy. And that's called foreigners' loss or terms of trade gain by the country. So right now, it seems to be the case that Trump administration is arguing that this tariff revenue is going to be large and it's mostly is going to be terms of trade gain, the lower red rectangle. The green rectangle is how much domestic consumers are going to have to pay for the imported products, and that's their loss. But they're claiming that that's going to be very small, and most of the tariff revenue is going to come from the reduction in price in world prices. In the short run, that seems to be the case. In fact, tariff revenue in the US has jumped. But in longer term, the thing is that producers around the world may have options, and in the long run, they face more options, and therefore they may actually dodge the tariff and try to avoid it. As a result, the domestic price, world price does not go down that much, and as a result, most of the tariff is going to be imposed, is going to come from domestic consumers. So with that background, I now end my presentation, and if you have any questions, let's start. Let me see if I can answer your questions.
So Hadi, let me ask you a question. So, sort of we've seen some depreciation in the US dollar recently in the last few months, right? How does that feed into the picture? Is there a potential connection between tariffs and the exchange rates?
Uh, yes, uh, what's going to happen is that if tariffs are imposed, then
Hmm.
you're not buying as much foreign goods. So
Hmm.
foreign currency is going to depreciate relative to your currency. Now that
Hmm.
may look odd because right now US dollar seems to be losing value,
Hmm.
but that comes from another factor, another effect. And that's the haphazardness of policies in the US has basically reduced confidence in the US economy, and people don't want to hold that many dollars.
Hmm.
This is countering what would have happened if there was not this uncertainty effect.
Hmm.
The dollar would have appreciated and would have made it easier for the rest of the world to maintain its price.
Hmm.
And because the US, in terms of dollars, the price would not have risen much
Hmm.
because US dollar becomes strong and therefore buys foreign goods very easily.
Hmm. Thank you very much, Hadi. Well, all right, folks. Let me share my. Let me ask first if there is any other questions for Professor Esfahani. Anyone? All right. Okay. Let me share my screen. And I apologize in advance for my graphic that I created in ChatGPT. And so let me share that presentation now. Um, all right. If I can figure out how to do that. Okay. Here we go. So I do apologize for what me worry about tariffs to both ChatGPT and to Mad Magazine, but this seems to be a bit of the reaction right now. And so these are the same background materials that Hadi shared a few. And so let me talk about the U.S. economy first. So right now, the U.S. economy seems to be doing relatively well. If you look at the economic growth, and generally speaking, I use the Atlanta Fed's GDP Now engine for sort of looking what the predictions are about economic growth at any given time, because obviously it takes time to measure those sorts of things. But Atlanta Fed typically does a very nice dynamic forecast that they update. Sort of like every couple of weeks. And so that's a terrific resource to look at. But right now, we're projecting about 2.6%. And actually, the economic growth for the first quarter of 2025 was actually a contraction. So initially, it was estimated, I think, closer to -1%. So this has actually been revised in the past couple of times. And so it looks like -0.6 annualized, of course, was the quarter one economic growth rate, which at the first glance seems to be a bad thing more or less, but we'll talk about why this was the case. We are also seeing the consumer price index inflation basically stabilizing to 2.4% as of May of 2025. And I think next week we'll see the results for June 2025. And the unemployment rate, and the June numbers already available, was basically 0.1% down from May. So all in all, the impact of tariffs doesn't seem to be terribly great. And you can also see from the market reactions as the president and the president's administration announces, new potential tariffs, like the president recently did in early July. Basically saying as of August 1, we'll see higher tariffs for a bunch of countries. The reaction seems to be meh. Initial reaction, if you look 3, 4 months ago, initial reactions were extremely strong. At this point, it seems that the markets are not necessarily taking those new tariff pronouncements to be very credible pronouncements because they simply don't react to them at all. But let me take a small pause. RPG, I see you have your hand up. Go ahead and ask your question.
Sure. Oh, okay. Yeah. I both unmuted video and audio. Okay, that's fine. My question, Professor, was so if the economy has grown, which is 2.6% is what in Q2 US, basically what we learned in the macroeconomics class is that if the economy is expanding,
Mhm.
that means usually the interest rates, the federal interest rates would have gone down. right?
Well, if the
The
economy is expanding, so typically, yes, this is a signal for the Fed to essentially dial down the contractionary policies and potentially take down the interest rates. That's correct.
but I don't believe we saw a reduction in interest rate. Even a flattened interest rate is also a
It
it means
did.
it tends to decline.
Well, yeah, it hasn't been changed since December of 2024, right? Sort of right now, the
Right.
current range is 4.25 to 4.5%. And so there is a couple of potential explanations that I have here. Explanation number one is that the Fed is still not terribly sure what the impact of tariffs is going to be because the economy is doing well, right? I think the Fed was more or less successful to getting the economy to something that resembles a soft landing. But and I'll talk about the reasons for this. But for a number of reasons, it thinks that the sort of the tariffs have not been reflected in this performance yet, right? And sort of we'll talk about the reasons why it takes place. And my explanation number two is that the Fed, and I've been saying that for a few years, I think the Fed lost a huge chunk of its credibility back in 2022 when it failed to respond to the reports of increasing inflation, saying, "Oh no, these are temporary changes. No action is necessary." And so when inflation went up to nearly to higher than 9%, right, for a few months, this was a significant loss of confidence. So Fed is working very hard to reestablish its reputation as the inflation fighter. And so in terms of looking at its dual mandate, it's probably going to be prioritizing inflation over employment in making those decisions. And so these are my couple of explanations, but I'll get more towards the first part of the explanation in this presentation. Did I
Okay.
answer your question more or less?
Yeah, I think so. Yep.
Okay.
Yeah.
All
More or
right.
less, the key is I know there is a lot more to it. I think I need to try different things to get my understanding right. But yeah, your explanation was very helpful nonetheless.
Well, let's try to decompose some of those things a little bit more, right? Sort of to look at the
Okay.
impact of tariffs.
Sure.
So a couple of interesting things and a couple of interesting graphs from the economists. So first of all, sort of what they predicted before and what economists' standard prediction is that if you increase tariffs, what you'll probably see is an increase in inflation and a decrease in economic activity. And keep in mind that depending on the share of imports in countries' GDP, increase in inflation could be higher or lower, right? Sort of if there is very little of imported goods that your economy uses, probably the increase in inflation is going to be relatively negligible. So as Hadi said, also what impacts that is the size of your market, right? Sort of is your economy simply subject to the world price, but does it have the potential to actually influence the world price? And so that part matters. And what we've seen is tariff collections. If you look between January and June of 2025, in June of 2025, the tariff collections were a little under $30 billion during that month. This is a significant increase, right? If you look at the numbers here, right? Sort of if we were for sort of many months, and this was probably consistent with the average because usually U.S. economy would collect about what 120 to 150 billion dollars in tariffs, and so somewhere around 10 billion per month looks great. And so what you see in here is that the tariffs collections almost tripled, right? Significant increase in here. But you know, we'll talk about whether this actually is a lot or not. So, do we know if the doomsayers were wrong? Well, there is a few explanations in here. So, first of all, as Hadi mentioned, we've seen significant stockpiling of imports both in late 2024 and in the first quarter of 2025. And this actually is the key reason why the GDP growth rate for 2025 quarter one was negative at negative 0.6%. And so where does this 0.6, 0.5% come from, that contraction? Well, you can see that imports actually increased quite a bit. So let me see if I can use the pen. So imports increased quite a bit. And so what you're seeing is that net exports share is basically declining by 4.7%, right? Because imports essentially count against the GDP when you bring something to the country. We also saw a very small decline in government spending on 0.2%. We've also seen consumption is still growing, but it's slowing down quite a bit. The rate of increase in the consumption component of GDP, which is about 70% of GDP or so, was basically an increase of 0.3%. Investment was up, right, which by nearly 4%, which serves as a really good argument for those saying, well, we're going to bring more of domestic manufacturing back to the United States, right? You can say, well, this looks to me like an argument that the firms are ratcheting up their domestic investment. This is exactly what President Trump was promising, right? Whether it's sustainable or not, we'll see. And I'll talk a little bit about the GDP now estimates for the current GDP growth rate, right? And so then what we're seeing is that this net impact of roughly negative 0.5%, negative 0.6%, these are obviously estimates, so plus or minus 10, 20, 30 basis points probably is quite possible, right? But that's what we have. And so the economists are basically calling Q1 your tariff whiplash quarter, right? Economic growth would have been okay if not for the significant imports and stockpiling of and their stockpiling, right? Okay. But let's continue talking about whether those good times are going to last forever, or whether they are going to last for a long time. Um, and the judgment is, at least my judgment, probably not. Well, good times never last forever. But what we are seeing is that obviously inventory stockpiling is being run down. That's the truth of it. The manufacturers in many industries, especially industries that have a bit of a political exposure to them, like auto manufacturing, haven't increased their prices yet, right? So if you go to the websites of a lot of foreign automakers, like go to Nissan and Honda and Mercedes-Benz and Infiniti and all of those, right? And one of the points that they're trying to make very hard is that we're not changing, sort of like in the next couple of months, our manufacturers' suggested retail prices, right? I mean, it's not necessarily a terrible argument because we all know that the automotive manufacturers discount their prices quite a bit, right? So you may keep MSRP the same, but you may simply give lower discounts than you used to give before, or you can actually get rid of those discounts forever, or especially if you have shortages of cars, your auto dealers may actually start charging a premium, just like they've done during COVID-19. But that's a potential consideration, right? Um, but there is a very strong possibility that, sort of even with those political considerations, they will have to raise their prices in the future, and many industry probably will do so, even if it's by a couple of percentage points, right? We also know that imports in the US account for roughly 1/6 of the GDP, maybe 15 to 16% or so. It seems like a large number, but it really isn't. First of all, it has increased by about 3 times from under 5% where it was in 1960s. But if you look at other countries, Germany is 41 to 45%. France is 32 to 35% or so. Why is my mouse not working? Sorry about that. Japan, a little closer to the United States at 18 to 20%, but China actually is higher, right? Sort of it accounts for 17 to 20% of the Chinese GDP. So that basically means what that means for the United States. So the impact of higher tariffs probably is not going to be huge, right? So if we had an import share more like Germany, it would have been a very different story. And I think we would have seen much higher inflation already. And then if you decompose tariff impacts, and this was a chart from The Economist that is based on an article published by a Harvard professor, and I'm giving link to this article at the bottom. So if you're looking, so remember 100% basically is your baseline in here, right? And if you're looking at, sort of unaffected, so let me start with imported. If you look at imported goods, you're seeing increases that are there. They're relatively moderate increases of a little bit under 1%, right? During the 2025. if you look at the affected domestic industries, the one that use imports for a component of what they make, so they also have had some ups and downs, but generally speaking, the increase is probably more like 0.6, 0.7%. But if you're looking at the unaffected domestic industries and those products, those prices have actually dropped. So they're seeing a little bit of a deflation in here. And so the argument might be is that deflation exists because of slowdown in consumer demand potentially and slowdown in investment. And so generally speaking, that slowdown is indeed taking place. If you look at the GDP now estimates for the month of June or for the end of the current period, they're seeing that both consumption and investment growth, and remember they were relatively higher in the first quarter, but as of now, they have slowed down to about 1%, right? So we've had, almost 4% growth in investment in the first quarter. In the second quarter, not so much. It's coming down below the regular growth rate. And so this serves as an argument that maybe the tariffs are not quite having the impact on the domestic insourcing as the presidential administrations claimed it would, right? So that's slowing down. And so the argument in here, supported by the prices of unaffected domestic goods, is that there might be this indirect impact of tariffs basically pushing inflation down by slowing down the rest of the economy, right? Which is much larger than the share of tariffs in the economy itself, right? So let me ask if there's any questions so far before I go to my next slide. All right. And again, don't be shy. Just unmute yourself. You don't have to raise your hand. Unmute yourself and speak up if you have a question, okay? All right. Let me go back and try to figure out. All right. So let's talk about whether this is more of a delay or less than a dodge. So we're seeing a new wave of tariff announcements, right? Sort of on July 7th, the president sent out letters to 14 countries, basically stating that the new tariffs are effective August 1, right? And those tariffs, so some of them are tariffs of, about 25% on Japan and South Korea, right? Which is much higher than the average tariff rate. There is a proposed tariff of 50% on copper, which is very significant in a year or a year and a half or so, about 200% increase in pharmaceuticals. And so the potential impact here might be that the effective rate could go up to something like 16, 17%, maybe a little bit closer to 20. That would be twice the current effective rate. And so if tariffs keeps continuing, companies have delayed price increases for a number of reasons, including both weakness in consumer demand, but also political consideration. But if tariffs continue to go up, price increases are likely inevitable, right? And there would be a higher impact on inflation. If there is retaliation by other countries, right now it's limited because folks in other countries are basically entertaining the presidential administration, but it possibly could pick up and hurt exports and thus hurt GDP even more. And again, exports in the US are relatively low compared to a lot of other countries. They're about 11 to 12% or so of GDP. So the impact is probably not going to be huge, but it's likely going to be noticeable. We're also seeing what Hadi talked about before is the relabeled exports. So they're typically called transshipments. And so an example in here, China makes something, sends those goods to Vietnam. They get labeled as Vietnamese goods and they get exported back to the United States. There is probably a pretty good amount of that going on, right? But the United States is starting to crack down on this practice and issuing, and there have been some legal cases, some justice cases where this resulted actually in significant fines and potentially prison terms, right? And as the United States cracks down on that, the impact of tariffs will become a little bit more pronounced. And well, a lot of countries are basically taking a wait and see approach, right? The Economist calls it the Dove approach, diplomacy over visible escalation. And, part of it might be due to the what they call a TACO principle, which is the abbreviation for Trump always chickens out. again, not carrying a value judgment in here, but just describing this tongue-in-cheek description of things, right? And so, even with all of those things, however, to keep in mind that tariffs are not a saving grace for the government budget either, right? So, even if you say, look, they're going to collect 6 times more tariffs what they were in 2024. In 2024, we basically collected about 120, I think, billion, 110, 120 billion annually. So, even if it grows to something like 600 billion, 650 billion, 700 billion, this is still going to be, sort of at most 12% of the federal government revenues. It's, an increase because tariffs had essentially been the lowest, the lightest source of federal government revenues at 1.5% back in 2024, but it's still probably not something to write home about, um, uh, and it's a concern certainly, right? And so my sense here is that this is right now more of a delay. We haven't dodged the issue of tariffs contributing to higher inflation, but that potential is absolutely there. It's still going to be a little bit more muted compared to what it might have been in many other countries that are much more engaged in international trade, like countries in the European Union. But still, the impact will show itself. It will be visible more in some industry than on the others, but it still remains a significant concern. And so, and we'll see how the Fed is going to respond to that as the new data comes in. But Fed obviously is very much data oriented, despite the fact that data obviously comes with significant lags in measurement, right? So we might actually have a significant problem on our hands already, but we may just know about it yet, right? And we might learn about that in a couple of months. And that's what I have. But let me ask you this. What's your own sense? Do you think we've dodged the tariffs impact? Do you think that we're going to see a lot more impact in the second half of the year? What's your own sense? If anybody wants to speak up, please go ahead. Also happy to take any other questions too.
Hey, Professor, I have a quick question, mainly about like the monetary policy. So, like, let's say that the tariffs do turn out to be inflationary, and from what I've heard in money and banking, the Fed doesn't really have the tools to, or interest rates don't really affect trade policy. They don't really have, or at least have a muted effect on that. So if the tariffs turn out to be inflationary down the road, what can the Fed do, or what does the Fed do about that? Do they just keep interest rates sort of high?
That's right. That's right.
Other prices from rising, even though it doesn't have a direct impact on tariffs, or what's
well, it has somewhat of an indirect impact, right? But we can talk about a couple of different things that might happen in there in terms of impact. But yes, generally in those cases, that's why Fed is not really lowering the interest rates quite yet, even as it sees signs of the economy potentially softening up, because it knows that the impact of tariffs is probably yet to be seen in its fullness, right? And it will have to go by data looking at how this changes. So there is an impact on the exchange rates to an extent for tariffs, right? And so as Hadi mentioned, typically when you impose tariffs, that reduces your exports potentially, that reduces your imports, and that reduces the demand for the currency from the other country, right? So your domestic currency might appreciate. Right now, what we talked about is that the currency actually depreciated due to the loss of investor confidence and the assessment of a higher risk associated with buying United States assets, especially government securities. But putting that aside, the relationship between interest rates and exchange rates is there. So if you look at this setting where let's hold all things constant, right? All of the policy rate constant, but let's say that the only country that increases the interest rates is the United States, right? And none of the other countries follow that. If that takes place, then typically what we expect to see is that the demand for the US currency will increase because investment opportunities in the United States might be more profitable. Buying government bonds could be more profitable because those yields will go up. And that leads to the appreciation of the US currency, right? And if the United States currency appreciates, that can hurt the, sort of the imports on its own potentially, right? Sort of because imports become more expensive. So there is another mechanism there, but there is absolutely a connection between interest rates and the value of the currency. All right. Excellent questions, folks. Anything else that I can answer for you? Or that Hadi could answer for you, for that matter? Any other thoughts? Oh, let me ask you this. Do you think that the threats about new tariffs coming August 1st, how much credibility do you place in those? How likely do you think that there is going to be anything close to what was stated in the demand letters mailed out to other countries? What's your own sense?
Gotta wait for the taco, all the chickens out.
All right.
Yeah, that is a funny way of saying it. But yeah, I didn't know about this so far. I got to learn something.
Right. So, sort of, okay, you're saying the taco principle might work out in there, right? So, okay, all right. Anybody else? Any other thoughts? Vivian, I can always
Hey,
count on you for a good comment or two.
I'm not so sure about that, but thanks again and nice to see you and Hardy again. Hey, I'm always curious about the effect on consumption because as
Uh-huh.
you have shown us the GDP calculation, right?
Mhm.
Consumers are really the huge chunk of our economic activities and all that. So
Mhm.
with all the things going on, things like that, how exactly the consumers are gonna continue to shore up our GDP?
Yeah, to an extent, right? Consumption obviously is large. This is, two-thirds, a little bit more than two-thirds of our GDP. But what we're seeing is a much softer consumption, right?
Hmm.
And so it looked okay in the beginning of the year. As of now, it's really the consumption growth rate is, sort of all is down under 1% growth, right?
Hmm.
And this is probably nothing to write home about. And the investment is contracting as well. And Hadi, correct me if I'm wrong, but investment tends to be a lot more sensitive to the changes, to the things like that, right? To the interest rates compared to consumption. Consumption, in a sense, if you gotta consume, you gotta consume, right? You could say that, well, sort of there is higher ticket items that consumers might delay, like washing machines and things like that, cars, so on and so forth. But remember, if your washing machine breaks down, you probably don't have much of a choice but to buy a new one, right?
Hmm.
Again, consumption doesn't react very quickly to those
Hmm.
things compared to investments, but investment growth rate had slowed down considerably, and consumption rate is kind of anemic right now. So
Hmm.
generally not a good sign, and so we'll see. We're seeing concerns both on the consumer side and on the businesses side about in terms of their expectations for the future. It looks like those expectations are very muted, and
Hmm.
that's what contributes to those decisions potentially not to invest and not to spend too much.
So you are saying that actually the reaction is still pretty muted, and then maybe there won't be too much fluctuation because, as you
That's right.
mentioned, that if we need to buy toilet paper, we still need to buy toilet paper,
Mhm.
just unavoidable, right? So if that's the case, then the new tax bill that give
Mhm.
a lot of rich people a lot of tax credits or whatever, so they should have a lot of more money to spend. So does that mean that would be actually better for the economy going forward?
Not necessarily. So I think the point that I was trying to make about consumption and investment growth rates all
Hmm.
looked much better in the beginning year than they do
Hmm.
now, right? When they
Hmm.
haven't seen the full impact of tariffs. I think
Hmm.
as the full impact of tariff makes it here,
Hmm.
then we will see probably more significant adjustments to the investment portion of GDP. And but both of them are already growing much slower, under 1%, as
Uh-huh.
opposed to a growth rate of 4% for the first quarter, right? For
Mm-hmm.
investment. So that softening is starting to take place,
Mm-hmm.
despite the fact that the full impact of tariff have not been felt yet. And so if
Mm-hmm.
there is more
Mm-hmm.
of that, then there
Mm-hmm.
is a significant potential for investment contracting quite a bit. So I'm saying
Mm-hmm.
that investment will contract more compared to consumption, but
Got
both
it.
are likely to certainly slow down in their growth or potentially even decrease.
Got it. And then the
Mhm.
tax bill is not come to the rescue. So the rich people
Oh,
can spend their
I mean,
way out of
if you look
our.
at the tax bill, right, at the big beautiful bill, the budget bill, right,
Mhm.
essentially a lot of it, sort of being treated as new policies, but it's not. It's a continuation of the existing tax policies that are already in effect right now, right?
Mhm.
So from that part of the tax bill, where sort of like the GAO treats that as sort of decreases in spending, but from the practical perspective, or decreases in revenue, right? But from the practical perspective, revenue is going to be the same as it is now.
Mhm.
So sort of that impact is still quite sort of quite negative on the budget, right? We are
Mhm.
continuing to run significant budget deficits.
Mhm.
We're continuing to essentially restrict the revenue quite a bit for the federal government, right? And so there is no significant change to the policies from the last years, right? In
Mhm.
terms of running a more balanced budget. And you could
So
see it
you.
from the numbers too, like sort of the
Mhm.
government spending contracted a tiny bit, but it was literally 0.1% annualized, right? So it
Mhm.
decreased by, I don't know, it decreased by 0.025% basically during the last quarter, which is 2.5 basis points, right? Sort of nothing,
Mhm. Mhm.
it's a contraction, but not a huge contraction. Government is not really spending less than it used to.
But then, so you are saying that maybe the tax bill is not gonna give us enough boost to the.
Uh, so the challenge of the tax bill is that so it does give a little bit of the short-term boost potentially, but
Mhm.
in the long term, the impact overall is negative, right? And if you
Mhm.
take into account that the markets are becoming more and more concerned about US government debt,
Mhm.
and the markets are starting to attach a risk premium to the US
Mhm.
government debt, which they
Mhm.
didn't do before. The new budget bill doesn't really help with what VC wanted, right? Sort of we haven't cleaned up, we haven't increased revenues. The revenues actually went down. And spending, if there is decreases in spending, they're relatively small decreases when everything is said and
Mhm.
done, right?
Mhm. Got it.
So it's the same
Okay.
trajectory that we've been following. And in the past session, I think maybe a couple of years ago, Hadiadai said that there's maybe only 20 years left for the United States to be able to run on the scores. It might be less than 20 years, right? Sort of that fiscal space, it's shrinking, right?
Mhm.
We're entering the stage where we might be running on thin air. It's just important not to look down, right? Sort of that you don't stop running.
But
Yeah.
I've also heard about discussions that this physical uh, discussion has been going on and on and on. So people kind of like, you know what? Maybe it's not gonna be such a huge problem because we have been living with this problem forever. Then.
That's right. So we've been running deficits since the Bill Clinton years, right? And
Mhm.
so there have been a number of folks very high up in the policy, very high up in the business, who kept saying over years and years ago, this needs to stop, or we'll have a catastrophe in our hands in a couple of years.
Mhm.
Well, the chickens might be coming home to roost.
Well, if we're crying wolf all the time, and then all the politicians not gonna just like, for their political future, they are not gonna cut, whatever, right? They were gonna keep spending. So unless something really bad happens, I doubt nothing is gonna
That's
be done.
yeah, that's the concern that I have too. Yes, absolutely.
Well, anyway, thank you, thank you.
All right. Okay, folks, any other questions? Anything else you wanted to ask or suggest for the
Hi,
next
Professor.
set of topics? Hello.
First, Professor Flood, long time no see. Good to see you again.
Great to see you too. Welcome back.
Thank you. Yeah, thanks for sharing what your thought on this. I joined later, so I didn't see the first part.
Uh-huh.
But I think if you see analysis and also read other, article, I
Uh-huh.
think many people don't agree with, the tariff policy from the Trump administration, and also especially maybe for short term, you see the increase on the, tariffs. But I think many article, I think also for long term, it doesn't mean it's good for the U.S. economy. And I think also, recent announcement, adding tariff to the 14 countries, to me means that the first phase is failed. So Trump tried to use another round, to get adding pressure other countries. I just wonder, how long will this last? If many economists think this is not beneficial for the U.S., why, nobody can stop him, or when
Well,
will Trump change his ideas?
here's the trick, and Hadi, please contribute to that too. So I think, sort of the economists generally have a very negative view of tariffs, right? So
Yeah.
Hadi presented in the first half of our discussion kind of model that on a microeconomic level contrasts the setting of a relatively small country where the
Hmm.
impact on tariff is going to be rather negative and very pronounced versus impact on a large country like the United States where the one of the key assumptions of the typical model that the country is small enough related to the rest of the world, and so it cannot impact the world price, so that doesn't hold anymore, right? And the idea here
Hmm.
is, given the size of the United States and its importance and imports, the impact of tariffs is going to be more muted because it will contribute to the general lowering of the world price, essentially, right? Sort of which takes some of the pain away and makes it a shared pain between foreigners and the domestic consumers. And this is what is helping us, right?
Okay.
As well as the fact that, there has been stockpiling that took place, right? Sort of, which means companies are still running down whatever inventories they stockpiled during the end of 2024 and the first quarter of 2025, right? So we're simply not seeing the impact of tariffs yet in full, right? And if that impact is going to be seen, one thing that I'll say about President Trump is that he tends to be a fairly pragmatic politician, right? So I
Hmm.
think if it starts impacting the United States, so he will potentially find opportunities to, change some of the policies, right? Find opportunities to blame it on somebody else, like the Federal Reserve, right? And their
Yeah.
high interest rates. I mean, there has certainly been precedent for that, but the bottom line is that there is probably going to be an adjustment in policy to right the ship, right? Or at least I hope that there will be. Heidi, what's your
Yes,
take?
same. What you said, I agree. I think Trump probably will be flexible down the road as long as he can come up with a nice cover story
Mhm.
that shows
Yeah.
that everybody else is really bad and can't be worse than that, and he's the best, and nobody in history of the world has done as well as Donald Trump.
Yes,
Yeah. Look like
there's
he's listening to his advice. What's his name again? Um,
Peter Navarro.
Navarro. Yeah.
Uh,
I think he's not expertise on this area, right? He has his own theory, but it's true it's not working because I think Trump expect in the first phase most of the country will negotiate with
well, Peter
US. But what
Navarro
happened?
certainly.
For example, between China, China didn't really follow what Trump thought. So yeah,
Yes, yes. Though China is sort of, I think, feeling some of the impact of the tariffs already, right? Even despite the transshipment about things like that, because China's economy is softening up a bit too. So, but we could also talk about that in one of the next session.
yeah,
Actually, this might be a really fun topic to discuss. But Peter Navarro certainly is one of the folks who holds relatively unorthodox views compared to the rest of economists and macroeconomists. And he certainly has a very high role in the domestic policy, even though in the domestic and international policy, right? Even though I mean, it seems like his advice kind of takes a spotlight, then somebody else comes in, then he comes back. there is some competition amongst various advisors that the president has, including Navarro and folks with more pragmatic views or more orthodox views, I guess.
Yeah, I think the president should hire you or the other professor as an advisor instead of Navarro.
Yeah, I wouldn't quite go that far, Hadi, certainly. Myself, maybe not, but there is a number of
Advising
very
Trump is
talented people.
precarious.
Yes.
Advising Trump is not a good idea because you don't know how he interprets your advice.
Yeah. If anything wrong, he'll blame you.
Exactly, exactly.
Yeah.
Mhm.
You need people like that to blame for whatever goes wrong, and he
That
takes
certainly could be a
credit.
management tactic for sure. Yes, yes.
Yes,
In some sense, sort of like and I've experienced that at one of my jobs in the past when I was a higher education administrator. But one of my bosses had a bit of a reputation as somebody who sort of would be affixed to a shiny object for a few months, and then sort of the spotlight would move to somebody else. And when I started working, I was sort of surprised at how cool people were initially to me until somebody told me, well, you're shiny right now, but wait a few months and you won't be anymore.
That's like what happened with Elon Musk, right?
In a sense, yes.
so
Okay, thank you, professors. Yeah, very much.
All right. Okay, folks, we're a little above our time limit, so let me just do one last call for questions if there is anything.
Hello, Professor. I have a curious question because I mean there are a lot of African countries that were given a tariff, but I'm not too sure how does it affect those countries? How does it affect us? Like, okay, there's now a 14% tariff on all of us,
Mhm.
and I'm wondering who suffers. I
Well,
know it should.
well, generally speaking, the consumers do, right? Because the idea of tariffs, sort of especially in many developing countries and many countries in Africa, is the economic case is a strong case against tariffs, right? So the usual couple of exceptions are the exceptions related to national security. For example, things that are key to the economy, that are key to the economy's security, both economic and military, probably should be produced in the country, right? And so from that perspective, it might say, okay, sort of like some of the military stuff, we will place tariffs, so outright prohibition, so that we can be safe naturally, right? But another popular argument in developing countries tend to be, well, we have small fledgling industries, and we need to give those industries time to develop. And this is why we are going to protect them through tariffs from competition with goods and services that are produced by the foreigners, right? And this is the argument that is used in nearly every single case when tariffs are imposed. So we are basically giving a handout to those specific protected industries at the much larger expense of the consumer, right? And I think this is certainly true for sort of most tariffs that you see in Africa, and that really doesn't contribute to economic growth or to the consumer welfare. And typically, those protected industries, once you kind of push them out to start swimming on their own, a lot of them will still drown because they haven't been made tough by tariffs, right? By competing with others intensely. Basically, we've protected an industry for years and years, and all of a sudden, when they say, well, we expect you to kind of make it on your own with much higher competition, very often those industries will fold or be acquired by the foreign industries and made a little more efficient. It's a tough place to be in, but generally speaking, the impact of those tariffs tends to be negative.
let me add that I think the question was also about the Trump tariffs, how it affects Africa. Did I understand
Ah,
this correctly?
Yes, yes, that's the question
That
because
go ahead.
there are two different schools of thoughts on the ground. Some people are going like, yeah, this is a good thing for the
mhm,
consumers because formerly, a lot of the things that are produced here, the best of it is exported to America, and
mhm,
then we are left with the little bad stuff that is now hiked at the price because it's scarce and all that. So there's a school of thought that goes like, okay, this tariffs are good because it means that the incentive to export is not that high, so there'll be more high quality products in the country. So I'm wondering, is that
But
realistic or
but
would I'm not too sure.
but look at it this way. If you're a producer and you're exporting to the US and bringing in the money and investing and growing that way, suddenly the market shrinks in the US because of tariff and you can't sell. So your income goes down. There are fewer workers that you can support. There's less investment. So from production perspective, it actually is very costly for developing countries. But what Trump is trying to do is to change, to take advantage of this moment where the US has primacy in the world economy, uh, to grab whatever he can from other countries. And this is a short-run phenomenon because in the long run, those countries are going to find other markets and move away from the US market. It's it's not it's got long run is a lose-lose deal. But other countries will adjust to these policies. In the short run, we saw that the tariff rate has tripled, tariff revenue has tripled in the past few months. That's because people did not have much choice. They had already sold their products, and when the product arrived in the US, they had to pay the tariff. So they do this once, twice, but then they immediately they start looking for alternatives. Let's sell to somebody else who doesn't play this game. And
Hadi, Hadi, can you make an argument that potentially in the short run, there might be a little bit of the positive impact to those countries because the world price will be pushed down because of the United States actions? And so essentially some of those countries in Africa, what they'll see is a somewhat lower price on efforts, on imports because of those actions.
That in principle, I agree with you that could happen. But the problem is that while their prices go down, their income also goes down. And the kind of products that US imports is not necessarily the kind of imports that African countries have. So those differences are important. And I think essentially the biggest impact comes from the revenue that exports from developing countries generate for them.
So at the best, then the impact is going to be sort of closer to zero, but most likely it's going to be negative overall.
Right. I think it's going to be negative, and the negative effect is going to become less and less over time as people rechannel their exports and trade.
Okay.
Okay.
All right. Good deal.
Yeah, thank you. Yeah. We'll see how it plays out.
That's right. That's right. So they'll do regular updates on what's going on, and they'll try to figure out how the upcoming economic numbers, sort of what part of them might be due to the tariffs. All right. Well, folks, we are now 10 minutes beyond our time limit. So thanks very much for joining us. Hadi and I would love to hear your suggestions about any of the possible topics. So you can leave those comments in our discussion board on the LinkedIn group, and hope to see you back in August. Thanks all. Talk to you soon.
Thank you. Thank you, Professor.
Thank you, Professor.
All right. Bye-bye now.
Bye.
Bye.
Thank you.